let me introduce Kevin Lepsoe, who's obviously the founder and CEO of Infinity. Previously to this, he led Morgan Stanley's financial engineering and structuring department within fixed income, and you can obviously see with what's being built here, a lot of the foundational stuff with what you were doing in a past life. So let's kick things off with the presentation.
All right, thank you for coming here. I think the most important message I want to get across today is this idea that, at least over the last couple of years, we've all been talking about like tokenization, real world assets, institutional crypto. And invariably what this revolves around is something that we all know quite well, at least many of us from a previous world, and that's called fixed income. And so I'd like all of us to just acknowledge that like a lot of this really does revolve around fixed income, and kind of going forward, let's continue this conversation around institutional crypto being more fixed income, or institutional crypto fixed income. I entered this space in, there's the Dwight thing. I entered this space in 2010, not professionally, started mining a bit of Bitcoin on my computer with a buddy. We don't know where that computer is, but that was kind of my first foray. I think many of us have kind of like a similar experience, but I spent 12 years in finance. I then moved into tech, and then in tech, one of my early investors here in Hong Kong, they were some of the critical infrastructure guys in the crypto scene. They invested in me back in 2014. Back then, I wanted to think of Bitcoin as a currency, and if it is a currency, let's just treat it like yen or euro, whatever it might be. And in that case, can we create interest on it? Can we do cross-currency swaps? Can we do options? So on and so forth, right? But that's 2014. You don't have a lot of this infrastructure that's now in place. And so what I want to show you now is that we actually do have a lot of this infrastructure coming in place. And so as we do that, let me first talk about really the kind of like, actually I'll get to that in a second. I want to talk about the players in the financial system. But before I do, just quickly, my team, most of us are ex kind of TradFi guys. We have 22, 23 folks in the company now. About 2/3 are engineers. Half of those engineers are TradFi, quants engineers. Half of them are regular, tech Web 2 engineers. And the rest of us are just a mixed bag of folks from the product side, as well as, actually that last third, half of us are engineers as well. But so yeah, very engineering heavy, but very quanty, mathematical in terms of background. Our investors are amazing. A number of them are here today. And so if you see anyone from these companies, thank them and for helping us make this happen. Where am I here? Yeah, basically just want to talk about the players in the financial system. And so anyone know what this is? Well, this is the players in a financial system. One of the largest systems, and this is the shadow banking sector. It's basically a map that the Federal Reserve created following GFC in 2008. I think it's a 2009 or 2012 update. The purpose at the time was basically to understand the market for credit and credit intermediation. And of course, the backdrop behind the financial crisis was largely credit related. And so if you're going to regulate that market, you need to understand it. These are the players in that market for credit. What we're ultimately seeing is that on the far left side, you have your borrower, and on your far right side, you have your lender. So when you go to the bank and you borrow money, you're going to pay 5%. Someone over there on the far side is going to earn 1%. 4% is all just disappearing into this ether called the shadow banking community, finance, financial sector. This is ostensibly what we're all here for, right? The goal of crypto in some shape or form is to challenge the rails that are currently in place within the traditional financial system. This is what it is. And not many people understand how this works. That happened to be my group at Morgan Stanley. We basically created products that would help the different participants kind of hedge or understand or transfer and convert the risk from one part to the other. But it's a complex beast. Nonetheless, in finance, like many of us would probably remember, is that you always potentially think about the day that you'll be made obsolete by like a spreadsheet, right? And so, that's really the goal, right? So can we replace that and those 12 intermediaries with a spreadsheet and, Yes, we can. In crypto, we don't talk about spreadsheets, of course. We talk about lines of code. But it is absolutely possible, and we're very close to it. So those are the players within the financial system. That's why we're building, what we're building. Just going back here. I guess the two goals, the two reasons I want to highlight this. So really one is that this is the end goal. We want to kind of strip out, make that part more efficient. The second thing is that we talk about money a lot in crypto, money and stable coins. And yet there's an intimate relationship between money and credit, right? There's $5 trillion of M0 money in the US, but there's $71 trillion of credit. And so credit is a much larger beast. It can look and behave like money, but it's not. It's far more complex. And so we need to understand this if we're going to be able to understand money within the future of finance. So yeah, so that was the players. This is the structure of the financial markets. And this is what we call the non-arbitrage kind of structure of the financial markets. It's largely driven by math and I guess economic theory, like what incentivizes people to act in the certain ways that they do. In most cases, it's free money or arbitrage, right? And that really drives the interconnectedness, the relationships between everything that all of us do within a financial market. And so, yeah, on the top side of it here, you have basically like equities or FX. We might call these like single factor markets. And on the bottom side, you have fixed income, a bit more like multi-factor. We can discuss that later. But this is crypto today. You have basically some definition of money, whether that's stable coins as they are today or CDBCs. You have spot, and you have all this other stuff. I don't know if you can see where it's highlighted, but these first 4 or 5 are what are called cash markets, whereas further down, those are derivative markets, right? So you could have $100 here in a position, but you could have $1,000 kind of replicating that position. Nonetheless, these two are highlighted. In crypto, we obviously trade futures and options. There's a whole bunch of that stuff that goes on, right? But this is a map about non-arbitrage trading, and it's, again, what drives and ties the markets together. We don't have interest rates yet properly in crypto. And if we want to get futures to be done properly and fully hedgeable, we need to get interest rates done to like an institutional or a high quality level. Most importantly on this page, this is the financial markets, and everything relies on getting this done right? So to the extent that we can do this, the rest of everything will kind of fall into place. And that's this slide here. Okay, convergence of financial markets. I posit that we really only need 2 things to make this happen. The first thing is the markets today logically separated, right? You have your traditional financial markets, you have your crypto markets, and they move kind of independently. The Fed might raise interest rates, or they might raise them again, and Bitcoin, might rally. But logically, there's no formula or no mechanism that naturally makes you want to kind of trade one versus the other. And so that's kind of where we are today. Tokenization. We had this kind of flurry of tokenization 5-6 years ago. I'm talking about this in the equity sense to start. So you might tokenize like Tesla stock, and it's fractionalized, and now more people can trade it, but it doesn't really do much. A lot of the discussion around tokenization and headlines are really about banks doing it internally, right? So you take like a JP Morgan, we've done like $1 billion, $1 trillion, whatever of tokenization. None of that is going to be seen in our world, in the crypto world. It's going to be seen on these private networks internally. And it's going to be seen, it's the same thing as them saying like, we're using like this type of database and we're going to shift to another type of database. That's really all that's happening. But functionally, they might have a series of processes and they're just going to make 1 or 2 faster. So we need to understand tokenization in the way the TradFi guys talk about it and the way kind of the crypto guys talk about it. What's far more important than this concept of tokenization is the tokenization of bonds. Now this part is critical. Again, they trade as completely separate worlds. Now, when we can tokenize treasuries, and we already have tokenized like money market funds. I don't know if Eugene, Open Eden guys are here, but here we go, right? But tokenized money market funds, and we can bring them on chain. Now we are fundamentally trading an instrument within the TradFi world head-to-head against a stablecoin in this world, right? So the moment you bring those two assets together, how can we force these assets together to create some type of arbitrage to now bind the two ecosystems together? And so the tokenization of not just money market funds, but in the future treasuries, a 1, 2, 3, 5-year treasury, that will be critical to bring these markets together. So that's number one. Now, fundamentally, how do we bring it together, right? If I have in this example, I have a 5-year treasury paying 5%. We could tokenize that treasury. We could bring it on-chain into the world of stablecoins. And I could borrow stablecoins at 3.5%. And a logical person would buy treasuries, borrow at 3.5%, spot it back into, off-ramp it back into dollars, buy more treasuries, back and forth, back and forth, back and forth. Basically closing this arbitrage, right? And what that does is it creates a logical binding between these two universes, right? So that creates a yield curve. That creates a backbone for the synthetic dollar. Whether the future is, USDT, USDC, CDBCs, or something else, now this entire digital world is, it has this kind of backbone to be complete. And in some sense, at this point, you don't need to, okay, I care about ETH and Bitcoin, but you kind of don't need to care about them at this point, because now we have the rails for the rest of the TradFi financial system. We can have credit markets, we can have interest rate swaps, cross-currency swaps, credit, a whole bunch of other things, because we've now bound their curves together. So this is the second part, basically, to bring those two worlds together. So there you go. Yeah, basically tokenizing treasuries, bring them on-chain, and now you have one component of that ecosystem trading here, and then boom, the rest of the ecosystem is there. All right, but you can't do this without technology and a platform to do it, and that's us. So we're launching our rates trading and financing exchange, and I'll show you now quickly how it works. Okay, well, there you go. I'll sit back here. So in the DeFi world, I guess you're familiar with like Aave and Compound and things like that. This is the simplest experience we can offer here. But it's basically just lending or borrowing on a floating rate or a fixed rate. And you don't need to worry about like limit orders or market orders. It's just like you lend and borrow. Maybe there's a little bit of a slippage, and like that's it. This is the most kind of basic experience, and we can do it for ETH and a handful of other tokens. We're really just going to start with blue chip tokens today. For the more sophisticated trader, we have a full kind of experience, and so this is unlike anything that's out there. I mean, it's exactly like a CeFi experience, but it's non-custodial. And so you come up to us with your MetaMask and you trade through your MetaMask. This is kind of like the real deal. We have kind of market orders, limit orders, full order book, trading view, positions, duration, yada yada. If you're a developer, we have a full set of API docs you can integrate with. Over here, just what are your positions? I want to highlight that here. If you are holding on to deposit tokens like Aave tokens, A tokens, Compound C tokens, we could potentially risk manage even like Uniswap LP tokens or Curve LP tokens. We can take your liquid staking tokens at the bottom, but most importantly, again, these tokenized real-world assets. And so, you can walk up to us with tokenized money market funds with Open Eden, for example, or a Matrix Port doc, have their STBT. In some short period of time, you can come up to us with a property, and we'll provide financing. So that's where we are, like, very soon. And finally, this is just your risk. So you can break your risk down into FX sensitivities, interest rate, kind of curve movements, et cetera, et cetera. If this stuff matters to you, we can talk about it in more depth. But there we go. So just a couple more slides here. That's it. We'll have two venues. One is permissionless, and the other will be permissioned within a full KYC AML perimeter, basically opening this up to everyone. From a use case perspective, it's unlimited, right? I mean, this is TradFi interest rates, but it's within the digital asset sphere. So anything that we've wanted to do within that TradFi world, we can now do in this space. And so there's obviously your net lenders, treasuries, yield farmers. There's kind of net borrowers. You have guys who are like, professional miners, right? You might borrow in dollars and you might earn like Bitcoin yield, and you have that kind of cross-currency risk. You can swap that back into dollars now, right? You might be a professional ETH validator, right? Again, borrowing in dollars and validating in ETH, swap that back into dollars, boom, done, right? On the flip side, I might be a Bitcoin like hodler from the early days, and I'm investing in the dollars world, and I want to swap my dollar returns back into crypto. Easy peasy. So complete set of use cases, but on the trading side, we'll be looking to integrate shortly or soon, hopefully with kind of a Talos and like Falcon X, with exchanges helping to offer kind of that back-end liquidity. A handful of banks as well looking to build their prime businesses. It's a very capital intensive for banks, and so from that perspective, they could have a capital-light business basically backing out liquidity through us. But similarly, of course, Fireblocks, Zodia, and a handful of others, Hex Trust downstairs as well. Looking to work with these guys to figure out this. That's it. I kind of talked about it. Basically, we can provide financing on basically anything. Just speak to us about it, and then that's it. Various market-making incentives. Custody, we'll be having, looking at off-exchange settlement on the permissioned entity. We will eventually have a token for whitelisting, and there we have it. So, thank you for this. Again, if there's one or two words that you remember here, it's just fixed income, right? And we need to start kicking this off in crypto. A lot of the discussions have been around more like FX or equity-like related business, but if we want to go down this institutional path, we need to start figuring out fixed income. So thank you. I'll take a quick Q&A if anyone has questions. Otherwise, we can chat later. But
Who holds custody for the institutions?
sure. So there's two venues. Both of them are currently non-custodial. So it's held within a smart contract with a multi-sig. So currently in a CeFi-like context, you would transfer it to the exchange or to a custodian. Here we basically hold those tokens within a smart contract, and you can see them in your MetaMask effectively there.
Doesn't work for family office and institutions.
Sure.
That need a qualified custodian.
Yep. So currently we're in the process of basically setting up with the custodians on that part, but this is our first step. Yeah. Okay, let's move on. Spread the word. Amy.
I'm here.
Where are you?
Hi.
There you are.
Hello.
You can just flick through there.
With the down button?
Yeah.
Okay, great. Well, good afternoon, everyone. Can the guys in the back hear me? And I use the word guys literally because they're all dudes over there. So. Awesome. Well, thanks, everyone. When the lovely guys from Infinity Exchange asked me to join this event, I did not know that I had to give a monologue for 5 minutes. And I thought to myself, like, what can I say that my clients have not heard before and that's not going to make my competitor giggle to themselves, right? So I figured I'd use the next little while to share a bit more about what we've learned in the last 5 years. And you can look at the slides, but listen to my voice. The reason why I think it's important is we've serviced now over 1,800 customers. And in our journey in servicing them, we realized that to those gambits of clients who were two men in a garage, trading crypto, all the way to banks, they all had really unique challenges. And I figure I'll use the 5 minutes today to share with you guys some of the unique challenges that folks in the industries are facing that we have experienced, and use the last 2 minutes to share a bit about a solution that potentially could help solve those challenges. So the first thing when we started back in 2019, it was around security, right? That time, people didn't really have a wallet solution that could be utilized to access infrastructures that was very frequent. At the time, cold storage was considered the ultimate safest option. They wanted a solution that allowed them to trade really actively with each other, but doesn't have to be on-prem, that can access to it 24/7. So that's kind of where we started. So number one problem that we noticed in the early days to users, and these are mostly your brokerage, trading funds, mostly asset managers at the time what they're really faced with. And then from there, we actually realized, you know what, the third-party attackers, they're troublesome. The North Koreans are quite difficult to deal with, but actually more likely the assets were lost due to the fact that your internal control were inappropriate, right? So that's why we start building sets of tools around operational controls. How do I protect my assets from employees that I've hired, given the fact that these are bearer instruments, right? How do I protect the fact that my traders cannot log onto an exchange and all of a sudden, find out information and withdraw assets to wherever it goes? To your point around institutions, majority of crypto infrastructures back in the days were built for retail individuals. How do I manage 100 people shop where I don't know who I've hired, and how do I get them access to the system that allowed them to improve efficiency? In addition to that, we also realized another area that happens a lot was fat finger. So if you actually look at the amount of assets that were lost, people will say that it was hacked, but the reality is a lot of people end up sending assets to the wrong place. If you traded crypto long enough, you've done it, you've experienced it, you felt the jittery feelings when you enter an address, and you don't know if it's got there or not, right? So that's the second thing that we realized people were paying with. Finally, the third thing we realized was scalable infrastructure. That was really when the exchanges back in, I would say 2019, to become kings of the industry, right? When they really scaled out, acquiring millions of users, and what they wanted was a really robust wallet infrastructure that works all the time, every time, 24/7, no outages, and blockchains are finicky, right? The second you move away from Bitcoin and Ethereum, all the other blockchains, I hope nobody's worked for a blockchain here, but it's really hard to work with. There are a lot of on-chain issues that to deal with. So scalability was a huge thing, and during the 2021 boom, the big thing was how do I manage a client that has 10 million wallets that are effectively doing, at that point in time, I think we were managing around 20% of all the Bitcoin on-chain transfer at that point in time. So how do we scale that out at a super rapid pace? So that was the third problem we solved. Then it became the banks. The banks are fun, right? They are really important because ultimately they're the ones who today owns all the money. So what they wanted from a digital asset infrastructure perspective was the flexible deployment solution. One bank are happy with cloud, another bank wants HSM only, one bank wants this type of compliance tools, another bank wants this type of governance tools. We realized that actually none of them want the same product, so we effectively took what we built and just spit it out into a modularized solution. So now, today you come to Fireblocks, you don't get Fireblocks on its own, you pick and choose your own journey, how you like to sign, where do you want to sign it, what governance tools you want to use, and so on and so forth. Then comes the DeFi boom, right? Where smart contract operations becomes even more important, I would say, from a wallet security perspective. A majority of the hack we've seen the last year really comes from the smart contract management perspective. And if you think about what that means is you can take the skills that it took from a security perspective to manage assets from a storage perspective. Now you can do it for smart contract signing, smart contract deployment, and all of these security benefits that comes with that. And finally, last point around operational scalability, right? So what that means is now you've got folks who are managing really wide sets of assets, with a lot of people managing them across DeFi and CeFi. How do I set it up so that people can use a unified platform to manage all my workflows? The final thing I didn't put on here, which is the newest, probably the most exciting development in our industry at the moment, which is the emergence of non-custodial wallets. I would say that trend really is driven on a lot of the stuff we're seeing with corporates and folks wanting to deploy a really unique Web3 experience and improve a lot upon the CeFi kind of infrastructure that we have today. And that's kind of the final things that we've learned in the last, I would say, 6 years, 5 years in market that we've been. Okay, in terms of the next section, I'm going to skip this part because I don't think it's as interesting. So I want to talk a little bit about off-exchange. The reason why I want to talk about this is because when we looked at what were the challenges in the last 2 years, we realized that there's not really too many things wrong with the assets, but there were a lot of things wrong with the operators that was managing in this space. And in fact, the idea of having an off-exchange product, which effectively, for those of you who are not familiar, is a way for an asset manager to stake collaterals on a centralized platform without those assets leaving their control, okay? And that was really important, and we started this idea in 2020, and at that time, I gotta be very honest, no exchange wanted to work with us. They were very happy with the centralized management model, and the risk for them was not really acceptable. Fast forward to a world where SBF ruined my birthday. And then here we are. now most exchanges are kind of open to having these discussions because the reality is asset managers and prop shops and institutional investors are demanding a level of improvement upon their infrastructure, and they simply are not trusting a exchange to own not only the matching role but also the custodial role, right? But at the same time, not all of them also wants to segregate that to a custodian either. I'll tell you why. Because in the traditional world, you've got 4 large custodians that does everything. In the crypto world, you also have quite a few custodians, but these custodians are not folks that have been having capital balances, been operating for hundreds of years, and the same legacy as someone like a Bank of New York Mellon, right? These crypto custodians, ultimately, despite all the things that we do try to improve and do better on, we still, compared to the traditional custodians, we're a startup. Right? And for a lot of these institutional investors, even that's not sufficient enough. And in some ways, where they feel like I'm just substituting one counterparty risk with another counterparty risk, because as we have seen last year, regulated custodians in the US have failed, crypto custodians. So what we have decided to help to support is taking the same lens that we've always have done, which is using technology to help mitigate risk. We have now built out a solution which allows you to eliminate it slightly differently. What does that mean? Our customers today use Fireblocks because we're a self-custody solution, which means that when you use Fireblocks, you have full control over your assets at all times. And then when you do want to trade on one of the exchanges that we have on the platform, you simply lock up those assets. Okay? Now I should show you the diagram, it's very easy to explain. You simply lock up those assets, and Deribit is the first exchange that we're launching later on this month. And you have something called a collateral vault, right? And the exchange sees you've locked assets in that collateral vault, and they give you immediate trading credit of the same amount for you to have access onto the exchange to trade. Now, from there on, depending on what your activities are, if you're doing a spot trading, they probably want to settle immediately. If you're doing options trading, in the example of Deribit, right, they will probably want to do a total amount number locked to sweep on an active basis. What does that mean? Deribit could say, for you as a counterparty, I'm happy to extend $100,000 worth of unsettled collateral. And if you do hit $100,000, they will initiate a sweeping function, and that will send an API into your system, which then you have the decision to say, do I agree with this sweeping? Do I not agree with this sweeping? And your risk team will say, yes, the reason why we are moving this collateral over is because we need to deploy more collateral, we've done a trade, and let's say we have lost a certain amount of capital, right? And then you initiate and sign, then the transaction, then the assets will leave your collateral vault into the Deribit wallet. Now this is really different because when your assets are in a collateral vault, that asset belongs to you and is in your full control, right? There's no way Deribit will be able to sweep assets out of that vault without your approval, meaning without you actually physically signing that transaction on chain. So then the question becomes, why would Deribit do this? What are the ramifications? What if you don't sign? Like, what if you as a customer, we've seen this happen, right? 2021, trading shops were trading, and then you call up, email bounce. Isn't there anymore. So there's something in Fireblocks system called a backup recovery kit, which what we can do is leveraging a third-party vendor, you and the exchange could effectively translate what the old world called an ISDA into a codified settlement instructions, which means it says, if you guys agree, if you don't settle, i.e. don't respond to my settlement instruction within 48, 72, 24, whatever you and the exchange agree is a settlement time, the third party will have the ability to help provide the agreed function, which is to say, I want to go and sweep from the exchange back to the Deribit wallet, sorry, other way around, from CVA to the exchange wallet if you do not respond, or vice versa, where you as a customer request a sweeping of settlement from the Deribit side back into your CVA, and if Deribit do not respond for various different reasons, then the third party come in and help you to do that, okay? So that in a nutshell is the high-level architecture of this solution. And the basis for us to doing this, actually, to your point around interest rate. And I think one of the most things that people forget in our industry, when you trade in any counterparty, your yield might be X, but the counterparty rate's interest will be Y. And that Y, in some world, is greater than what you get for X. And in order for us to have a really healthy market, we need to figure out a way, how do I reduce that Y to less than 5%? If I don't reduce less than 5%, nobody actually will trade in a really meaningful way because the counterparty risk will outweigh the benefit you get in return. So this is where we start. We want to onboard more exchanges. We want to work with folks that would be interested in getting involved in this. The architecture is already in place, and because this is a technology solution, I want to take this one step further. You can use it for bilateral trading. So a lot of this what we'll be working on at the moment is working with large OTC providers who do large derivative settlements with each other. And they might also feel the same way that the risk they feel towards Deribit, which is I don't want to leave my collateral on an exchange. They might feel the same way about a counterparty. So you can actually deploy that in a bilateral way as well, where you're switching roles between an exchange and a trading party. So that's my presentation for today. Thank you guys so much for your time and listening. Hope I didn't bore all of y'all.
Excellent, thank you, Amy. Okay, can we get the panelists up here? Let's get these chairs. Let me come over here. All right. Who doesn't have a mic? Do you have a mic?
I don't.
No, so that's yours?
Oh, really?
Okay, pass it around.
I want to sit close to him.
Or,
Put to both of you.
Yeah.
all right, so let's get into the main event. So, as a self-confessed fixed income nerd who spent a decade working in various investment banks, this topic is very interesting to me. So let's jump into it. So I guess obviously I don't need to introduce Kevin. He got introduced before, but then obviously we've got CJ Fong, who's the managing director and head of APAC and EMEA and sales for GSR, one of the largest crypto market makers. He has a background in crypto since 2017, and spent the prior 10 years working in traditional finance, starting his career in the trading floor at Morgan Stanley, and then working at private wealth and fixed income solutions, still at Morgan Stanley, and then some time at Nomura Private Banking. And then we've got Moshe Shen, who's the Director of Business Development and Strategic Partnerships at Wintermute. Prior to joining Wintermute, he spent 10 years at Goldman Sachs, trading and sales in the equity division, prime brokerage, locations spanning across London and Hong Kong. And then obviously we've got John Cahill, who's the Chief Operating Officer of Galaxy Digital for the Asia office. Prior to joining Galaxy, he spent 19 years also at Goldman Sachs, and most recently running a hedge fund financing business in APAC, and has previously been in securities lending and synthetic product trading desks. All right, cool. So round of applause to everyone. Welcome. So we want to touch on two broad topics today. Obviously, as Kevin talked about, it's fixed income and sort of the interesting things around that, but then also what Kevin talked about, which was the convergence piece. And I think between these two broad topics, we're probably going to have a lot to talk about over the next 30 minutes or so. So as we get into it and we talk about like fixed income and I guess where we're at with this, I mean, I look back to the days when I was rebuilding interest rate curves post financial crisis, when we basically had markets dislocate and you no longer had simple interest rate curves working because you could sort of like have an arbitrage opportunity between 3-month and 6-month rates and stuff like that. And I've always sort of then come over to the crypto side and sort of waited and wondered when we're going to start to see yield curves and interest rate curves in this space. And I'd be interested to know the points of view of everybody else around this, because it obviously underpins a lot of what Kevin was talking about. So I guess as we sort of take a pause on that question, maybe just a quick sort of backgrounds from each of you, if you want to add anything, and then maybe sort of jump in on your thoughts on this. John, do you want to start?
Yeah, sure. So Galaxy Digital is a crypto-oriented investment bank and merchant bank, and so we're very much a TradFi-oriented organization. A lot of us have come from long careers in markets, and frankly, I think the fixed income space has been underrepresented, if not represented at all, in a meaningful way, in anything like what we had seen. I think what we're talking about here today is really foundational to the development of markets, to development of a whole number of products, and it really is kind of very early innings in how this is going to develop.
Wintermute. If you heard of us, we
actually
are.
have mics on the other side. I think they're not just putting their hands up.
Try. Wintermute, we're a crypto trading firm. We're similar to like a lot of these guys. We're a CFI company. So we trade for our own balance sheet, which are own profit. And we've been trading for a number of years, being grown to be one of the biggest in the market. Predominantly spot, derivatives, options on both on-venue or OTC. Again, like John says, very underrepresented. Without a yield curve, it's pretty hard to price stuff that clients or counterparties ask us to price. Like trying to price a forward, that's like far dated. It's very, very hard. Pretty like finger in the air. You have to look at the perp funding right now and the finger in the air. Very, very hard to do without a proper industry standard. So yeah, I think it's let's see how it goes.
I need to borrow this. All right. Thanks for having me here. GSR, I know most of you in the room in some form or another capacity. The only thing to beat the chest about GSR being one of the largest market makers is we're probably the only market maker in the world right now with the MAS in principle approval. It took us 3.5 years to get that. Good luck to the rest of the firms who have that application. It's painful, trust me. The other thing I want to comment on is Kevin knows what he's talking about, Infinity Exchange. And I say this because Kevin was actually one of my first bosses at Morgan Stanley. So I worked under him on the structured rate side of the business. And I echo what these gentlemen say, except I want to extrapolate it on one thing. I think convergence is one concept, but I think it will be convergence into parallel. And I say this because at the end of the day, I think we need to be realistic. Having the likes of the largest investment banks and pension funds come into our space, how we see it now, it's not going to happen. But it is a requirement to have the basics of infrastructure to be able to scale from here. What we are doing, if you think about it, and what Infinity Exchange will achieve by building out an interest rate curve, is it will almost give us that legitimacy in a so-called shadow banking concept where crypto firms operate. It will give tier 2, tier 3, tier 4 funds. It will give projects, users, traders access to a market that they currently do not have. And that gives the first layer. From then we can talk about all the great stuff, SPVs, multi-collateral trades, derivatives, correlation, etc. But we are far away from that. What we are trying to achieve here is literally where adults in the room over at the traditional finance, large organizations can look across at us and say, they have the basic building blocks. And from there, we can continue to grow. It's yours.
I have a mic, but...
Oh, you're cheating, man.
Yeah, I'm cheating. Well, just one thing back to here. So yeah, we did used to work together, but the reason I left was because I started to be outshined by guys like him as well. So yeah, at some point it was, there's this attrition where you reach a certain age and you're like, oh, time for the next guys to step up.
Bonus.
Yes. Anyway, you know my story, but I'll pass back to Dwight.
Cool. Yeah, so I guess when it comes to these building blocks and these pieces you're talking about, I mean, obviously, Kevin, you had the nice map up there and kind of showed where we're at and all the rest of it. And I think the way that I look at, obviously, a lot that's going on in the crypto space, especially with, I guess, probably some of the major tokens, not the altcoins, so like Bitcoin, ETH, etc., they're very much like an emerging market currency. And so if you're going to try and put an interest rate curve together for it, you've probably got some cash instruments, a little bit of money market, and then you're basically doing an FX forward through some NDFs or something like this to try and build up a curve. And then on the opposite side of the spectrum, you've got like fully developed markets like the US dollar, where there's probably like hundreds of instruments that sort of go in to the makeup of that curve. That probably includes all of the traditional instruments, cross-currency swaps, as well as it's benchmarked to other currencies. And so my question is like, if an emerging market is like a 1 and a US dollar is like a 10, where do you see us being in, say, like 12 to 24 months from now when it comes to the sophistication of the market, given crypto just moves so rapidly?
I want to hear from Kevin on this one. You mentioned 6 months, and I said, oh, okay.
Yeah, exactly.
You got my attention now.
Point.
Yeah.
Well, 6 months,
I guess
so.
like, if you start with an emerging market, take like Malaysia is just like a random, well, not random, but like an emerging market, right? I think you look at what are the types of trades we can do there versus like within a dollar market or a G3 type of market. Basically when we hit the go live button, we don't technically enable swaps and cross-currency swaps, but if I'm lending and borrowing in the same currency across different maturity dates, that's a swap, right? Mm-hmm. Both legs are funded, but it's effectively an interest rate swap. So we'll have interest rate swaps. We'll be able to have currency swaps of those kind of top 5 tokens. We have some infrastructure we need to do on the permissioned regulated side for custodians and whatnot to be able to facilitate kind of that Bitcoin to dollar types of swaps. But yeah, I'd say in 6 months we're just getting into it. 6 months on from that, it's really a matter of how much involved do guys like these really get involved in our markets to help kind of backstop it, right? Like the technology is there. How much liquidity are we going to have? Is it like $100 of cross-currency swaps, or are we going to quickly scale from, traders with their futures positions hedging out that basis risk in the interest rate market, which would really build a massive interest rate market, right? So it just depends really how fast can we move on our side to get guys like these comfortable to trade in our world. So 6 to 12 months, we'll go from like a 2 to a 4, but it'll accelerate very quickly.
Okay. Yep. And then obviously you guys.
He's targeting us.
Yeah. Well, I was about to say.
In the middle saying it's up to you.
Well, they say liquidity begets liquidity, and that's actually one of the things that we do as firms is we provide liquidity to markets. We've been doing it, at crypto exchanges now since day zero, and that's really what gets it done. The innovation here is arbitrage opportunity and market neutrality. That is what brings liquidity. Yeah. That's what brings people like us who have a bit of capital are going to put it at risk in a way that's controlled, with venues and counterparty risks that we're comfortable with, and that's what brings more liquidity. So we're certainly like the tip of the spear on that front. Yeah. But then things should snowball pretty quickly from there.
I think the only thing I want to add as well is we talk about the Diem and EM concept, and we're trying to liken it to crypto. Crypto extrapolates a bit further than that. And I'm going to use structured credit terms. You have your IGs, right? So you have your Bitcoin, your Ethereum. That's going to be easy. That one, everybody here is going to be involved in some form or another. Then we go into the altcoin space, and we know this well because altcoin market making is our main business. I think you will get a subset of those, 5 to 10 coins, where you can still extrapolate an interest rate curve. Now, whether or not we should get as aggressive and creative and do it for the rest of the credits, that remains to be seen. And I think the reason why as well is the one difference is the ecosystem and the nature of people trading the underlying. I think to get a lot of funds to trade a coin which is ranked 550 or 750 in the world, pretty hard to do. And as John mentions now, liquidity is probably the core concept there rather than having a proper curve to go 6 months out, 1 year out, 2 years out. But I do believe having that ability of a curve in the majors presents a lot of opportunities with regards to products, with regards to hedging of risk. And I do foresee it that if we can do it for certain larger altcoins as well, what we then almost create is ecosystem for trading shops to get involved with each other. Because right now that's not happening, right? Right now we offer our services to the market, to the street, for people who want to trade. We do a bit of prop when we see a bit of arbitrage there, but ultimately what you want to do is create almost what the hedge funds do in traditional finance space, and that requires that. So that's where I think we're going to go.
Yep.
Yeah, I'll probably add one thing is, if you're a crypto native crowd, you think about fixed income. It's a pretty boring topic, right? Like, what is that? How does that apply to me? Now, how many of you yield farmed before? Yield farmed? Yeah, all of you. We have a pretty big obsession with yield, right? That's why DeFi summer happened in 2020, right? Rates are zero. We all want extra yield. We all want to go to next Ponzonomics, get the 5,000 APYs, and jump to the next one, right? So we have a pretty good obsession with yield. Now we just don't know how to price it. What's the appropriate yield, right? Back in 3 years ago, yield was zero. So you're happy to get 10% for lending dollars, 20% or higher, or even 20% for Luna, right? We talked about earlier the credit risk. We didn't think about credit risk, right? When you are trading these altcoins, yield farms, etc. Now you have hopefully a benchmark, something that is people are trade is liquid, it's benchmark, it could be majors as it just said. How many altcoins you go to TBD? Depends on liquidity. Liquidity gets liquidity. But I say we do have a history of yield in crypto. Now there is obviously not anything remotely interesting in the yield space. In crypto native, we can get 5% on money market fund. Why would you try to risk counterparty risk on even a C5 venue or a smart contract venue? So we're able to see that how does that translate to crypto native side. But for the institutions to get in, for the really kind of we can now offer 3-year swaps out. I can't imagine how to do that right now. Yeah. But maybe soon.
How far out do you guys currently do anything, actually?
Probably options for probably 1 year.
A year.
For
right.
1 year.
We'll do it,
Yeah.
And not enjoy the risk.
Okay, got it. So if we have a 2-year part of the curve,
you'd be ahead of the curve.
Yeah.
So I mean, I guess on that point as well, and I guess to go back to what CJ said about being targeted, I mean, obviously you've got some interest rate borrow lends that's been available for a while now on exchanges, OTC desks, Aave, Compound. What does it mean for you guys when someone like Infinity comes along and actually offers this longer yield curve? Like, what excites you about the types of things that you can start to offer your customers?
I actually think it's an invitation to adoption for just a way broader range of financial operators, bigger balance sheets, who understand the fixed income markets, which is a vastly larger market than the equities market, for instance. And it's just it's another waypoint in getting to a full-fledged, self-contained operating system.
No, it is a market that the TradFi guys understand the yield curves, and it's much, as John's much bigger than equities. Whether that translates to how we as a firm we would look at capital, there is definitely cheaper rates out there, as you said, with exchanges, with Aave Compound. We don't really use that much of a Aave Compound, but more of a exchange side. So we just see whichever offers the best trading opportunities for us. But it's pretty foundational for the big guys to come in.
I'm going to approach it from a slightly different way. What excited me most about what Kevin showed just now was that split and that bifurcation into permissioned as well as permissionless, right? And the reason why is we get asked, and I'm pretty sure Moshe does as well, the Galaxy boys, to participate in every DEX on the street right now. And every DEX comes to us with the same pitch. We're faster, it's transparent, it's a club order book, looks exactly the same. But they don't realize that's not the problem, right? As a centralized organization with the right corporate structure and infrastructure in place, we're concerned about things like KYC, AML, counterparties, who am I trading with? And that's where that becomes crucial. I think that at the end of the day, being able to grow the curve and extrapolate, yeah, we can offer more. But then this goes back to basic structuring. How advanced do you want to get? I mean, the biggest acronym in structuring was always KISS. Keep it simple, stupid, right? The simplest idea to achieve the results of what a client is looking for. But to have that permission pool concept suddenly means you get a group of institutions who are like, look, as long as I complete KYC, I know I'm trading against somebody else who has also passed KYC. Sizes can go up. Counterparty risk now, whilst not fully alleviated, is now in a place where you can get comfortable with it. So I think that's what that's going to bring about with what they're trying to build right now. I think pure DEXs and Compound Aave, back to those, like them, we don't use it as much as well. We have access to the centralized venues to get cheap funding, right? And I think that's something that will always be there. It's part of the system. Just like in traditional finance systems, you have multiple layers when it comes to borrow and lending. And I think that's going to exist in crypto as well.
And then I guess outside of that, then I guess CJ, more for you, given the background that you had under Kevin, I guess be mindful of your answer, given he was previously your boss. Like, where do you see the structured product side of this going as these fundamental building blocks that structured products are built on actually start to appear?
And when do we build an interest rate vol market?
That one I'm all for. I'm all for interest rate vol. If we can get forward vol right, I think that makes a lot of sense. I mean, the caveat here is this. We shouldn't get ahead of ourselves. I think you see some desks on the streets going out there trying to price very similar products to what we saw during our days, right? You get all these hybrids with 2 or 3 different underlyings, and then you ask the guy how you're hedging the correlation, they can't hedge it properly. They're just taking a fade, right? You're just fading and saying, I pray this does not break. But let's be realistic about how crypto markets work. When the markets go up, correlation it's irrelevant, right? They're all slightly different between your Bitcoin, ETH, and alts. When the market goes down, correlation is 1. So how do you hedge for something like that, right? And I think the problem when you go structured products is take a step back, and this is the private wealth side of my experience, what I see of it, right? At the end of the day, the underlying thing is the search for yield. That's what a structured product is for. It is to achieve something higher than what I can get from a vanilla instrument. You still get it because the one good thing about what happened in the last 1 week was vols finally came alive again in the space. They had been depressed for the longest period of time. Now, do we go out of our way and do a triple rates range accrual with a spread, different parts of the curve? Doesn't make sense to do that now. There is no value add. Yeah, I can pay you 50% per annum, but there's a reason why it's 50% per annum. And as a trading desk, it's not what you want to do. One thing we have to be very careful about as desk, and this is where the responsibility of institutional players lies. We can't just go across and sell every product that we used to do into the market of crypto right now. There has to be some duty of care. And the reason why is come up with products that make sense. Now, can we go further though? Can we do digitals, which are already being hit right now in the market? Could we go into the concept of a steepener trade, for instance? That makes sense. Very basic level of structuring.
Yep.
But you don't need to go crazy because vol is there. Just like if you were to talk to your average private wealth client right now, you don't tell them to buy 10, 20% of the portfolio of crypto. What you do is you tell them to use the 1% of the 10% of alts investments that they do because the underlying vol matches it, right? The Sharpe ratio comes close to it. That's how you pitch something like this. So I think we evolve, but I don't foresee a year from now we do an SPV linked to rates, FX, and a commodity all combined together, backed by US Treasuries. Put it that way.
Wow.
Yeah.
Okay.
Maybe like a year and a half.
Yeah.
That's a lot of composability.
If you buy the first one, sure.
But just to follow on from this, I think the technical infrastructure is there to do these trades, right? How much liquidity is a separate issue. But the way we see it evolving is that on day one, it's that you have your floating rate lenders and borrowers who just want fixed rate. That's kind of the simplest things, right? So I can synthetically lend or borrow in fixed rate terms. And then there's guys who are trading futures, right? You're trading your futures versus spot. You have this basis risk. How do you hedge that out? How can you have no vol? And you can basically back out that risk through the interest rate market through interest rate parity, right? So these are kind of some standard trades that will just kind of backstop some of the liquidity as we get going. And I think following on from that, you'll start to see kind of like your arbitrage types of trades where it might be like your USDC curve versus USDT curve, right? Or again, like curve trades, take for example, like ETH staking, where is that rate gonna go, right? Is it gonna go up or down? What does the forward curve look like? And I just wanna take a long-term view on the ETH staking yields, and so we will have the closest thing to synthetic ETH fixed rate yields, right? So, how do I express a relatively simple view on these types of things?
It becomes very hedge fund-like. I think that's the right term, right? It's like seeing Revens come in doing 2-year, 3-year against 1-year, 4-year sort of thing.
Yep.
I think we can see that. But I don't think we're going to go down the path of multi-asset correlation and hybrids, and it doesn't make sense.
No.
I don't plan it.
Yeah. I mean, I also feel that like, while it's like definitely a hedge fund world, there's obviously a lot of companies out there from the hedging point of view. So I guess to the point of like where the ETH yield curve's going, like where do you guys see potentially structured products, not at the, let's say, app level of like a coin, like a Bitcoin, but at the actual protocol level of like hash rate or the amount of proof of stake or stake that's actually put into a network?
I think hash rate derivatives is something that everybody has looked at. And I think it's not the easiest thing to do, to be fair. There are ways for miners to hedge, but you don't hedge it on a hash rate basis. You hedge it on a production basis, right? And you hedge it based on a cash flow basis. And I think whilst it's amazing to do hash rate based hedging, and it's something that can be looked at, but at the end of the day, the way I've looked at it is it's a very dirty hedge. So I don't think we should go down that path yet. I think there is that market. What you're talking about really is nuances of crypto that are specific to crypto, and then putting a derivatives market on top of that. I think the basics need to come in first, so that there's enough liquidity there to be able to try other things as well.
Yep. Okay. And then how about from your guys' point of view when it comes to structured products? Get involved in it at all or looking to expand?
I think the market opportunity is demonstrably there. You look to TradFi, and the appetite, especially from the high net wealth community, is almost endless in a certain market condition. So yeah, it's something we've explored already. We haven't gotten too funky in the structured products that we've done, but we've done a handful. But the market is still kind of yet to be developed.
Yeah.
Yeah, similar. I think what we also don't have is, in TradFi you have the distributors. You have the banks that provide the product, and you have distributors that, the Citibanks or the Standard Chartered that actually go about distributing it to the actual crowd. You probably don't have that yet in crypto, so there needs to be a matching of the X family office looking for this business structure that we are happy to structure, and it's because the flow doesn't quite make sense right now in terms of the volume. You get pretty wide pricing and etc. Not so much appetite to price these kind of things, but as you have a critical mass of volume that comes in, then a lot of things require to be pretty standardized.
I think a permissioned world with qualified custodian participation changes that whole dynamic. Right? I think that's actually what we're missing, is banks are allergic to Elizabeth Warren risk, as I would be. Gary Gensler risk is real. So if you touch U.S. dollars, you own some of that risk, and so these these changes that are happening are de-risking some of those things, and they're doing it hand in hand with the regulators is the way to get there.
Yep. Okay. Cool. Yeah, I guess if we now switch over to the other side of what we want to talk about, and so obviously the convergence side of things. Obviously, Kevin, you shared your views on a lot of it. And I guess from my perspective, the way I kind of look at it is a lot of what you were talking about, like bonding two markets together. And I think, again, about what I would use, excuse me, what I was actually doing when I was at Credit Suisse, and sort of reimagining these interest rate curves where a US dollar is actually linked to a GBP, is linked to a euro through cross-currency swaps and cross-currency basis swaps, and you get this binding. And it's almost like the traditional instrument that's sort of sitting in the traditional space is actually being bonded over and bootstrapped over so that you can do all this relative value trading and all the rest of it, which in my opinion makes everything really exciting. I always looked at it in the way that the difference between those instruments should be the effort to move between those systems. And Kevin really opened my mind up to a much better way of doing it through tokenization. And I'd love to hear the views of you three when it comes to like where you see this going. The convergence of crypto and traditional finance.
Yeah, I mean, I can go first. I mean, we especially raised at 5. We've seen emergence of interest-bearing stablecoins. It's one that is actually going quite popular. Tokenizing a money market fund, giving yield to the stablecoin holders, and we've actually recently done a collaboration with Mountain Protocol, so USDM, where we can essentially redeem, do OTC with USDC to USDM, like 24/7, and then essentially we hold the risk of the weekend and redeem with Mountain as they go to money market fund to get it back. So with these kind of guys, there's others, there's Ondo that's doing this as well, interest-bearing stablecoins. It's a pretty sizable crowd that they could be targeting. Imagine all of your USDT or USDC lying in your wallet, like pretty nice getting 5% on that. Pretty nice getting using that as a TVL build-up for a new chain. Right? If you look at, say, a X chain that is super well funded, but does not have TVL, what about they swap their native stablecoins into interest-bearing stablecoin? I think that's probably pretty good appeal to get some capital on there. So we've seen that as a probably closest convergence is, as Kevin said earlier, you are allowing crypto crowd to access much bigger TradFi asset, which I think is end of the day it is one of the big appeals of blockchain is you're democratizing the access. Anyone can access these really funky products that high net worth individuals, families have access, institutions have access in TradFi world, but you now could have access on the blockchain side.
I mean, I think this convergence, it needs to happen. And the reason why is it shows that we can be adults about the business that we're trying to do. I think the one risk that we do have to be very wary about, though, is the closer we get towards a convergence, the more, as John rightly mentioned, we have to interact and work with regulators. Because we are touching a space that is very, very, well, it's established and there are rules. And you want to play by a set of rules to do it the right way. I think that, I mean, right now, if you talk about convergence, the one thing that everyone seems to be talking about is that concept of real-world assets, right? Tokenization of real-world assets. Yep. And I think that whilst it's great and everybody is banging the drum about it, I do think that we actually haven't taken a step back and thought about what is the real value of an STO. What should be tokenized, and to give, you rightly pointed out, democratization of assets, right? Does it mean you tokenize an equity? Well, it doesn't really make sense to me, right? Tokenizing a bond where you have minimum limits because of accredited investor rules, that's not going to change. That is regulatory for protection. It's not a product problem. But tokenization of private equity, receivables, loans, that could be interesting, right? And I think that's a direction that I do see as the first next step. I do think that nature of cross-currency swaps and that convergence that we're seeing there, the good thing is we're not supposed to reinvent the wheel. I think you rightly pointed out, right, what you saw during your career and what we see now. What we're trying to do is say, look, a lot of this has been done in TradFi. Crypto, if it's another asset class, removing the tech aside, but just looking at the underlying thing, it's another commodity, so to speak. Yep. Can we apply very similar rules? Can it offer similar benefits with its own nuances? I mean, that's why Amy was talking about earlier on. Well, the custodians are trying to figure this out to make it almost seamless in how we do it, so it feels the same. The one thing we have to realize is you are not going to get a hedge fund or a family office to change the way they invest. So the way you do it is you make the product that you offer them as close to what they're used to as possible. And I think that's something we're trying to get right now.
Yep.
I do want to chime in just a little bit. I think convergence can mean so many different things, but I do think at the end of the day, it's a software eats the world value proposition, and it's just like a better way to do this stuff. The technology's there, you know, the adoption will come. It's just better. Like eventually,
It's like
better wins.
just go use it, right?
Yeah,
like
that's it.
to your
Like,
point on like the two ecosystems, right? Like, yeah, there'll be two ecosystems, but just choose the one that gives you the less slippage, the better price, whatever.
And there's waypoints to get there, and it's a lot of it's you know the boring, unsexy work of interacting with regulators, building consensus, speaking with one voice, getting together in a room and saying, all right, here's our talking points this month, stuff of that nature. But like eventually, you end up there.
Yeah.
That's at least you know over a long enough time horizon.
Yeah. And then I guess another question around this as well, like, I mean, where do you, around the convergence of the traditional finance and crypto, and then like slicing right in between that CBDCs. And I say that in the sense that, like, you know, today we just announced with Ripple a project that we've been working on for 6 months, launching an EHKD pilot. And so where do you guys see these CBDCs feeding into this? I mean, Kevin, do you see
On my side, they just slip in as like another token or currency. I mean, we could do like stable coins or CDBCs and, you know, yen, euro, Hong Kong dollars. I mean, there's regulatory aspects to it, but from a technology level, anything will just fit in seamlessly.
Yep. Do you see stablecoins maybe disappearing and becoming a backseat to a full digitization?
On my side, that's a loaded
You're getting a
I'd say we let the market decide, right? If people can arbitrage trade in between the two of them, then, you know, if you take your USDC and USDT curves, people will go long short this all day, and the curves will eventually start to diverge. That difference will effectively be like a credit spread, and that'll communicate information in terms of like which stablecoins are better than others. And if there was a Terra stablecoin curve, it might have had a credit spread of like 15%, right? Glad we didn't have that at the time, you know. But that's where the market will price in risk accordingly, and the best we can do is just set up the rails so that really like these guys and their clients can do it.
Yeah. And that kind of leads me to the last topic I wanted to talk about, with like the arbitrage and the convergence of things, and specifically going back to the concept of Terra, and, you know, these like 20% interest rates that were actually happening at the time. I would be interested to hear your points of view. I mean, mine is that would quickly dissipate and become known as a fake thing because of all the instruments and the ability to, I guess, arbitrage away these things through this convergence. So do you guys foresee that, like, as these markets mature with all these products and all the rest of it, that we're not going to see as much of these types of events?
There's just no free lunch in markets.
I feel like
if you can't identify what you're getting an outsized return and you can't identify the risk, then be wary. Don't be excited.
Yeah.
That's that.
I feel like our best hope is that risk can be appropriately priced, right? And can we create the market infrastructures and the systems so that it's easy to equate a Terra with another stablecoin, right?
Yep.
And then, you know, again, it'll be appropriately priced, or it won't, and you'll take advantage of it, or you'll lose.
I think what Terra showed was that a dog can't go moo. And I think that's what we've established. I think and I mean globally, and everybody in this industry, we got caught up, right? We got caught up with the 21 bull run, we got caught up with the DeFi summer, NFT booms, etc. And we forgot the basics.
Liquidity tsunami.
Yeah,
it's not unique to digital assets.
Correct, it's everywhere, right? But we forgot the biggest thing, and that's credit. Like, actually, there is credit risk is something that is prevalent regardless of what you do. Every day when you do any form of transaction on the street, there is a credit risk component behind it. And we forgot about that. There's a reason why it's 20%, right? And I think if you were to pull the curtain away, you would see why, if you analyzed it, right? Obviously, pricing a credit risk, or somebody is going out there showing how his stablecoin works and how much reserves he has to back it, is not the smartest thing in the world. You probably price that as a straight default. But at the end of the day, I think we've learned from that. And we've seen that. Honestly, to give you real life what we see, we've seen that emergence of how treasuries from projects are managed on this sort of evolution. What happened, to give you an idea, was when it first came out in 2021, you had a lot of projects who would go to providers and say, look, I don't want this hassle, you manage my whole treasury for me. Sign very loose documentation, they go manage it for them. Then that sort of blew up, right? And you saw 3 hours go down the toilet with that. Yep. Then the next one was, okay, fine, let's do it in DeFi, because we have a bit of control, let's see what happens. And then Terra Luna happened, and you're like, okay, this doesn't work because I don't know who to complain to. What we then saw on our side, and then obviously the people like, okay, let's go back to basics, borrow lending platform, and then Celsius happened. So now what's happened, and what we've seen since then, is a lot of the board projects are like, look, we do it ourselves, and all we care about is what is your counterparty credit risk. I don't care if my yield level is 1% lower than it'll be outside, but I want to be able to look under the hood and see what you have. What are your financials like? How stable are you? How do you handle custody? We get asked a lot more of these questions now. And to me, it just shows the market is growing up. Because these are not being asked by family offices. These are actually being asked by project treasuries, which is amazing because a lot of these treasuries are now hiring guys who are ex-finance guys who understand this.
That's the convergence.
That's the convergence.
There we go.
We're finding jobs on the other side of the room. But yeah.
Any other views? Okay. Yeah, I mean, like on that point as well, I had a client last year who's a massive financial plumbing institutional company that I took to Token 2049, so pre-FTX. And the one thing that they said to me afterwards was like, no one's talking about counterparty risk. And there's obviously post-FTX, and I think we've obviously learnt this lesson, and everyone's talking about it some more. So I guess with that, I'll open the room up to questions. Does anyone have any questions they want to fire at these guys? Yep, go for it.
You asked a lot about liquidity. How important do you think retail participation is going to be this time? People that also know specifically.
So the question was, just for the mic, for the thing, was that we talked about liquidity quite a bit and just how important that is on the retail side.
I think crypto is built for retail. That's what it's for. It is that socializing, democratizing of an ecosystem, a metric, a financial system for them. Rather than having that whole shadow banking thing where you go to a pawn shop or a money lender concept, it's in crypto now. And it's something that can become very transparent, very structured. So I think, yes, we have to rely on retail. But when we say retail, what we need to avoid is going down the route of 2021, where a retail person comes in because they think they're going to 30x or 40x and then get out and then buy a new car. I think what you have to have is genuine interest in what we're trying to create. Now, will there be institutions in this market for liquidity? This has to be. But we're supposed to be pillars. So institutions in crypto become even more important than traditional finance. And the reason why is we're meant to be the adults. We're meant to be regulated the right way. We're meant to do things to a certain standard so that retail can feel comfortable to trade. And I think that creates a framework and an environment for retail to thrive. So I think it's crucial. I think a lot got burnt. But the one thing people don't realize, and this is the pretty cool part, retail has holding power. Like, I still remember, the one thing that FX traders used to say is, you never trade against Mrs. Watanabe, right? Back in the day, for the yen. It's the same thing, because they can outhold you, because they don't mind. And I think that's what retail will bring to the table. And that's why it's such a crucial component of the industry we're trying to build right now.
Any other questions?
What
Amy?
do you guys think about, obviously you guys compare a lot to like currencies, right? But ultimately when you build an interest market, you then have a healthy credit market, but Uncle Sam here to backstop when things go wrong. So that doesn't exist for Bitcoin, right? How do you guys think this will play out for a bearer instrument where there is no one who can make more Bitcoin for folks that can later on use the industry you guys have created, ultimately create a credit crisis within the industry?
It's like Lehman all over again.
But there's no Uncle Sam. Just let you go.
Well, there's also no like fractional lending or fractional banking in crypto as well, right? It's all kind of one-to-one. So at the end of the day, it's all accounted for in some sense. But I think back to one slide I sort of had on kind of that M0 versus like credit system. That's there because of this fractional banking system where you can just kind of like you can just create money, right? And so it's harder to just create money, I think, in the crypto space. Currently you need people to actually backstop it with some type of representation of a dollar. So I don't know, but I think that we don't have that degree of like leverage and just reckless money creation in crypto as we may have in the traditional world, which I think is a good thing. Yeah.
Great. All right, I guess I'll wrap it up. Oh, sorry, one more question.
If the regulators come to regulate DeFi, how does it look like? It's in the traditional world, you have your agents that get like the customer's KYC approved. So that kind of like sort of like help the masses to adopt. But in this case, does it defeat the purpose when it comes to regulators?
So the question is around regulation and DeFi and whether or not it will, I guess, add or inhibit adoption, just for the... Yeah.
For institutions coming in DeFi, it will probably be the permission pool, permission DeFi, where they will regularly require any participants to know who you're facing. And for us, it's similar. When we think about permission, it's like we need KYC with our counterparties. We need to know who they are, who their shareholders, who directors, etc. Now, permissionless doesn't necessarily mean that we can trade with anyone. It means we can trade with anyone who can trade in a permissioned manner, but also we need to take care of like who we're not allowed to fix. So we can need to blacklist various addresses, etc., etc., etc. So it's not easy to if you like how do you regulate curve, right? Like how does anyone regulate curve or Uniswap? It's not easy. But similarly, these guys, the true institutions, are not coming in for this. So does it really require the regulators to regulate? The institutions come in? Probably no. They probably be these kind of permission pools where they only regulate first, and then the bigger money can come in, and that's when you start to build some sort of regulated venue in DeFi.
Okay. All right. How about we wrap it up there then? We've a bit over time, so can we put our hands together and thank our lovely panelists and Amy.
Thank you, guys.
All right. Thank you, guys.